Listen very carefully to what I'm about to reveal, because this could be the difference between watching your portfolio stagnate and actually making serious money in these markets. Right now, in February 2026, while 99% of investors are chasing the same overvalued tech giants, a massive shift is happening beneath the surface that almost nobody is talking about. I'm going to show you exactly how to capitalize on that shift before the crowd catches on. But before we dive into these game-changing opportunities, do me a favor. Smash that like button right now and make sure you subscribe to Market Authority. It takes half a second, but it helps this content reach thousands of other investors who desperately need this information. Don't be the person who finds this video again in 6 months, wishing they had subscribed earlier. Here's what's really going on in the markets that mainstream media won't tell you. Everyone is completely fixated on the usual suspects like Apple, Microsoft, Tesla, and Meta. The same names get recycled every single day on CNBC. But while retail investors pile into these overcrowded trades, smart money is positioning itself elsewhere. Institutional investors, the ones who actually move markets, are rotating into areas where valuations make sense. These are areas where real upside still exists. We've moved past the era of empty promises and flashy presentations. The market now demands real results, real revenue growth, and tangible cash flow. Companies must prove they deserve your hard-earned capital. Today, I'm breaking down 4 stocks with serious potential, not just for February, but for the entire year ahead. These are not the overhyped names every YouTuber is screaming about. These companies have strong fundamentals, fortress balance sheets, and valuations that are reasonable, while everything else trades at extreme levels. Stick with me through the entire video because you'll walk away with 4 actionable investment ideas. Each one is backed by Wall Street analysts calling for meaningful upside. You'll want to hear all 4 before making any decisions. Let me ask you something. When was the last time you bought something on sale and regretted it? Quality assets at discounted prices are how wealth is built. That's exactly what we're seeing with the first opportunity. This is a financial powerhouse that just got crushed by the market, and that creates what could be the buying opportunity of the quarter. I'm talking about Capital One Financial, ticker COF. This company sits at the intersection of traditional banking and the massive credit card industry. Right now, the stock is effectively on fire sale, and here's why. They recently reported earnings, and the market punished them hard. Shares are down more than 12% year to date and nearly 20% from recent highs. This is where professionals separate themselves from amateurs. When a high-quality business gets punished without a fundamental change to the long-term model, patient investors pay attention. Let me walk you through the earnings because details matter. Revenue surged 53% year over year. That growth was driven largely by their acquisition of Discover Financial. This shows Capital One isn't just talking about growth, they're executing aggressively. Yes, they missed earnings per share estimates by 28 cents. That gave short-term traders an excuse to dump shares. But the real trigger for the sell-off was their announcement to acquire Brex for just over $5 billion. Brex is a fintech company focused on corporate credit cards. Markets hate uncertainty. Large acquisitions bring fear around integration, execution risk, and whether the company overpaid. But zoom out and look at this strategically. Capital One is making aggressive moves to steal market share from American Express and other premium card competitors. They're not waiting for conditions to improve. They're actively reshaping their business for the future. With a market cap around $137 billion, this is a major institution. Yet the stock is only up 7% over the past year while the broader market surged. Shares are trading near $215. That low $200 range is starting to look very attractive. Here's where it gets interesting for more sophisticated investors. You can use options to be more strategic with your entry. Selling a cash secured, put at the $200 strike expiring in a few weeks, could generate around $165 in premium. It also gives you a chance to own the stock at a price you're comfortable with. Now here's the real kicker. Analysts rate Capital One a strong buy with an average 12-month price target of $280. That's roughly 30% upside from current levels. 30% upside from a large financial stock in a volatile market is significant. Drop a comment below and tell me what you think. Are you already holding Capital One or considering starting a position on this pullback? I read every comment. And while you're down there, share this video with someone who's been asking you for investment ideas. Now let's shift gears completely and head south, way south into Latin America. Our second opportunity is dominating a region most American investors ignore, and it's doing it quietly. Mercado Libre, ticker MELI. It's often called the Amazon of Latin America, but that comparison undersells it. They're building a dominant e-commerce and fintech empire across South America. Their efficiency metrics rival the biggest global tech giants. The market cap sits around $112 billion. Shares are up 21% over the past year despite market volatility. When you dig into the numbers, the strength becomes obvious. Revenue has reached $26 billion over the last 12 months. Operating profit sits at $3.1 billion with margins around 12%. That's strong execution in a competitive environment. But what really stands out is free cash flow. It has grown for 4 consecutive years and now sits at $8.6 billion. The margin is 33%. That means 33 cents of every dollar becomes pure free cash flow. Most companies struggle to hit 5% margins. Mercado Libre is doing 33% while expanding aggressively. This tells you everything about management discipline. Capital is being deployed intelligently, not wasted. Some investors hesitate because the forward PE is 37. That sounds expensive until you factor in growth. Analysts expect earnings growth of 44% annually over the next 2 years. That brings the PEG ratio to 0.84. Anything under 1 is considered attractive. Wall Street agrees, giving Mercado Libre a strong buy rating. The average price target is $2,600. That implies roughly 20% upside. If you want international exposure with strong fundamentals and long-term growth, Mercado Libre deserves attention. This is a compounding machine. Now let's change sectors again. Let's talk about cybersecurity. Our third stock is Scalar, ticker ZS. Everyone is obsessed with artificial intelligence right now. AI is transformative, no doubt about it. But cybersecurity is the insurance policy that makes AI usable. Companies might slow AI spending during downturns, but they cannot afford to cut security budgets. The cost of a major data breach is catastrophic. Financial damage and reputation loss can be permanent. One breach can destroy decades of customer trust overnight. Zscaler has a market cap of $34 billion, and shares are only up 7% over the past year. That massively underperforms the broader tech indexes. This is where things get extremely interesting for contrarian investors willing to go against the crowd. The stock peaked in early November and has since dropped roughly 35%. Cybersecurity stocks have been under relentless pressure as money rotated out of tech and into other sectors. That rotation, however, is creating opportunity for investors who can look past short-term noise. Valuations are starting to look genuinely compelling again, especially for companies with strong fundamentals. Zscaler is actually growing and generating real cash. Revenue over the past 12 months reached $2.8 billion. That reflects strong top-line growth and continued customer adoption. The company isn't profitable on an operating basis yet. That means position sizing should match your personal risk tolerance. If volatility makes you nervous, don't go all in. But free cash flow tells a very different story about the health of this business. Scalar is generating nearly $1 billion in free cash flow. That comes with a margin of 33%. That margin is identical to what we saw with Mercado Libre. For a subscription-based software company, that level of execution is excellent. One metric you must focus on here is annual recurring revenue, or ARR. This is the lifeblood of any subscription business. Zscaler's ARR has surpassed $3 billion. It's growing at 25% year over year. That kind of predictable recurring revenue is what eventually drives profitability. It also creates massive long-term shareholder value. The stock isn't cheap by traditional valuation standards. It trades at a forward PE of 47 times. However, momentum is starting to shift in favor of buyers. Shares recently bounced hard off the $200 level after becoming severely oversold. Technical strength is starting to return. Institutional money is beginning to flow back in. Analysts rate Zscaler a strong buy. The 12-month price target sits at $324. That implies roughly 47% upside. That's substantial upside for a company with this quality and growth profile. If you believe cybersecurity is critical for the long term, this pullback matters. Security is only becoming more essential every single day. This could be one of those moments investors look back on as a major inflection point. Now, let's move to our fourth and final pick. This one brings us back to the AI theme from a very different angle. The company is Marvell Technology, ticker MRVL. They're not trying to be the brains of AI like NVIDIA. Think of Marvell as the high-speed nervous system. They connect everything together and make AI function at scale. They build the plumbing that allows AI data centers to work efficiently. This is critical infrastructure, not flashy headlines. The market cap is $69 billion. Shares are down 20% over the past year. Volatility has been intense, but that volatility has created an attractive entry point for long-term investors. Marvell has secured major design wins with Amazon Web Services, Google Cloud, and Microsoft Azure. These are sticky, long-term relationships. Once you're designed into these massive systems, competitors can't easily replace you. The switching costs are simply too high. Revenue is at a record high, just under $8 billion. Nearly $2 billion of that comes from custom AI work. Operating profit sits at $1.2 billion. Margins are approaching 15%. Those are strong metrics for a semiconductor company, especially when navigating global supply chain complexity. What truly sets Marvell apart is their acquisition of Celestial AI. Most investors have no idea how important this move is. Traditional copper wiring inside data centers is hitting physical limits. As AI workloads grow, copper overheats and slows performance. That creates bottlenecks that cap AI scalability. Celestial AI solves this problem. They specialize in optical interconnects. Data is moved using light instead of electricity. This eliminates a major performance bottleneck. It allows AI systems to scale efficiently. Marvell now sits at the forefront of next-generation data center infrastructure. This creates a competitive advantage that's hard to replicate. If you want to build cutting-edge AI clusters, Marvell's technology becomes essential. That's real strategic leverage. Free cash flow is trending in the right direction. It hit $1.6 billion over the past 12 months. Margins are around 20%. That confirms improving financial strength. Valuation is where things get very compelling. Shares trade at a forward PE, just under 23 times. Expected earnings growth averages 30% over the next 2 years. That produces a PEG ratio of 0.76. Anything below 1 suggests undervaluation relative to growth. Analysts clearly see this opportunity. Marvell carries a strong buy rating. The price target sits at $120. That implies roughly 45% upside. That's meaningful potential. And while everyone focuses on NVIDIA and AMD, Marvell wins quietly. It provides the infrastructure those chips rely on. This is a smarter, less crowded way to play AI, and it appears undervalued right now. So there you have it. 4 stocks across 4 very different sectors. Each offers a unique risk-reward profile. Each fits a different investing style. Capital One offers deep value and strategic repositioning. Mercado Libre delivers elite international growth and cash flow. Zscaler provides exposure to the essential cybersecurity trend. Marvell offers differentiated AI infrastructure leverage. Before you go, make sure you're subscribed to Market Authority. Hit the notification bell so you never miss what's next. Comment below and tell me which stock stands out most to you. Are you buying any of these right now? Share this video with your investing friends. These are the opportunities they need to see. Hit like, drop a comment, and spread this around. I'll see you in the next one.